Well, first of all, thank you all of you for coming. Listen. I know it's let's be honest. You had nowhere to go, free food. So so I won't let it go to my head too much. But no, but honestly, I'm really thankful that all of you came, especially Canadians, because I just want to tell Canadian friends we really love you, and what you hear from. Be your own country. All right. Okay. By the way, a couple things. Number one, this is really, and I really want to stress this is not a marketing event. I'm not here to promote IMA. So I'm just here to answer your questions. If you have questions about IMA, I have two gentlemen who organized this event, Cyrus and Robert, and they really put a great job doing this. So, but thank you guys. They put this whole thing together. So, if you have questions about it, talk to them. But I'm not going to talk about this here today. So I'm here basically to answer your questions and to hear from you. And I'm really touched you're here because, so I write 2 hours a day, every day from 5 to 7. And when you write, it's very difficult to write into abyss, right? So so when I write, I think about people think about your faces. Okay, well, you're gonna read my, what I'm writing, and that makes it so much easier to connect with my audience. So that's why I wanted to do this, so I can actually connect with people who are reading my articles. So one last point I want to make is that we live in a very politically charged environment. If you ask me a political question, I'll answer it. But if you don't ask me, it's even better. So I anyway, what's the procedure? So I need to speak up, and both of my kids are here. Well, I have 3 kids, but 2 of them are here. At the back, there's a Jonah right there, standing tall guy, and there's Hannah. She's right there. So at the end, if you would ask some questions. Oh, so I need to. Okay, at the end, okay, how about this? Okay. Thank you, Richard. Thank you. Okay. At the end, if you want to ask me questions, just, ask them questions, just, we can do that. All right, so how are we going to start? Where are the microphones? So the microphones here and there. Just come up to microphone, ask a question, and I'll try to answer. So, and tell us where you're from, your name and where you're from. All right.
Figured I'd jump on it while I had the chance. Ross Solomon, Austin, Texas. I'm a value investor, and I think a lot of times as value investors we're contrarians. And one of the things that I personally struggle with is confirmation bias. So I was wondering if there's anything that you do personally to avoid that, and if there's any advice you could give me.
Thank you so much for the question. I think us looking for confirmation bias is us just being human, right? Because when you were in a tribe and there was another tribe attacking you, you wanted to be surrounded by people who kind of share your belief systems or agree with you, right? So the confirmation bias is something very natural to all of us. Now, as an investor, my goal is, and I keep saying this all the time, but I really, really believe this, and I'm going to quote Seneca, time discovers truth, right? So as an investor, my goal is to discover the truth before time does, right? So when I look at a stock, when we look at a company, I try to talk to as many people about this as possible and try to figure out what other people think. And then when I find out what they think, so somebody saying, I don't like the stock means nothing to me. But when somebody says, I don't like this company, here's why, and they start giving me bullet points, that actually matters a lot to me because now I got a gift. I got a thesis to disprove. Okay, and if I can, so I got more data. So I always seek out other people's opinions. I'm lucky that I have a lot of investor friends who a lot of them became friends actually, and so I always seek out their opinion. But then when I listen to it, it's not I don't like it and that's where it stops. I'm listening for those bullet points. Here is why, And then I just start analyzing. That's for me. Those are data points for me to to analyze. I hope I answered your question. Other questions? Right there.
Hi, my name is Ken. I'm from Taiwan, and I feel very honored to be here and ask questions to Leslie yourself. So my question is, in a sideways market, do you think that selling put options and selling call options is a good strategy?
Selling put options. All right. All right. So I think, thank you for this question. So I think options, I'm going to be speaking general first. I think options could be a very tool in your portfolio as long as it doesn't blow you up. The problem with options, they can blow you up. A lot of times you can be looking like like in the Wall Street will sell you a lot of investments where you're looking for coins, for 10 cents on the highway, and then the truck runs you over. Options can do that to you. At the same time, you can use options defensively, and they can generate you extra income. So let me give you an example, and I think this is what you're alluding to. Hypothetically, we own Uber stock, okay? But hypothetically, it's an $80 stock, and and I think it's worth 100. That's not what I think, but let's say I do. Okay, then I can basically sell calls, right, at 100. And if Uber got it to 100, I would have sold it anyway. But this way, I still made another $3 or $4 in the process. That's actually in this case it makes sense, right? So options are just another tool that could be overvalued or undervalued. And if you use it responsibly, and most importantly, if it reduces risk and doesn't blow you up, I don't see any reason why not to use them. But again, like by the way, and also I would argue you don't want to overuse them because they should be kind of a icing on the cake, but not the whole cake. That's, so yeah. Hope I answered your question. No problem. All right there, hi.
Hi, Vitaliy. Jerome Vandergast from New York. Thanks for taking the time and answering my question. I'm curious how you think about time when it comes to the reward. At the IMA dinner, you mentioned one of the interesting things about investing is you don't know when the reward comes, and you just quoted Seneca. How do you deal with the opportunity cost of time, especially in a market where price discovery seems to be impaired, or at least working differently than it did in the past? Thank you.
That's a great, Jerome, thank you. Great question. So we integrated this into our investment process. And let me explain how we do this. When we look at a company, every stock in our portfolio, I'm trying to figure out how to explain a spreadsheet in the words. But basically what we do, we put a fair value on the company 4, 5, or longer years out. And then we discount it back. So why it matters? Because let's say there's a company that's not growing earnings. And then let's say there's a company that is growing earnings. So if I put a company that's growing earnings 5 years out, actually I'm getting paid with earnings appreciation, right? Now, if I put this, another company on the same scale, and 5 years out it's not growing earnings, then time is actually working against that company. So therefore, the discount at which I buy the stock has to be much greater. So in other words, if it takes 5 years for the market to revalue the company and it's not growing earnings, I have to buy it so much cheaper. So we have companies with different growth profiles, but internal rate of return 5 years out basically equalizes that. So that's how we deal with that. But I'm very another thing it does, it introduces companies in my portfolio. Like when I started investing, I feel like, I feel like every value investor goes through this transition. You kind of start in a dumpster, like you start buying these companies that look very cheap. like look statistically cheap and say, oh God, look at this, look at this wonderful coal stocks at 6 times earnings. Okay, this is how like almost every value investor I know, this is how they started investing, right? Because and it's easy and it actually makes sense. And this is how I started investing as well, because the reason it makes sense because I got my master's degree in finance. I've been taught how to look at a lot of numbers. So it's so easy to say company that's traded 10 times earnings is cheaper than the company, statistically cheaper than companies traded 15 times earnings. But so it's easier for us to grasp this simple algebra or arithmetic. Now, the true analysis comes to understand, well, okay, this company has a significant competitive advantage. It can grow earnings for a long period of time, right? This company has good management and bad management. This management is good at allocating capital. This one isn't. This one may not look like it has a lot of debt, but has a lot of releases or whatever. So this becomes qualitative analysis. So I feel like a lot of investors start with quantitative analysis first, like quantitative, looking at statistics, and then they graduate after they lose a lot of money and make a lot of mistakes, like I did. They kind of graduate to to adding qualitative factors to that. And growth, there is a value in growth. I am a value investor, and one of our largest positions is Uber, as you guys know, and because there is a significant value when the company doubles or triples or quadruples its earnings, right? The company becomes worth more. Now, it matters how much you pay for it too, by the way. So it's not all, it doesn't mean that anything is growing should be bought, but introducing these elements into your portfolio. And if you look at, like, a lot of times you look at a portfolio, like if you were to be analyzed by a consultant, like, and they would look and say, well, you're a value investor, but you own Uber, so it would break their models. Well, to me, it doesn't. It's their problem. But anyway, so we want to integrate all these components into a framework, and the way we do this is just by valuing, putting all the positions and 5 years out and discounting them back. So hope I answered your question.
May I ask a quick follow-up?
Yeah.
Just because you touched on competitive advantages and sort of the multivariate aspects, do you adjust?
Just 1 second. Is this better? Yes. Okay. All right. Sorry, guys. I can only get so close to this podium before it's. All right. Yes. Yeah.
So I'll ask this in a quick fashion.
Yeah.
Obviously, not all earnings growth is equal.
Mm-hmm.
And if I think about companies that have wide moats and the capacity to generate significant excess returns, so returns above their cost of capital,
mm-hmm.
how do you factor that in? Because you can have a company that's growing earnings, but to the detriment of its ability to generate excess returns over time. So just curious how you incorporate that in that IRR analysis.
Well, I think the math kind of speaks for itself. And if company does not earn its cost of capital, then to generate those earnings 5 years out, they're going to have to either increase debt or raise equity, for the most part, right? So oversimplifying it. And also, that company probably not going to pass our quality screen. So there's a kind of several mechanisms that kind of, I think quality, we are, when I, as I matured as an investor, the way our portfolio looked has changed. And the way it changed is that I started to realize life is too short for me to own, kind of low quality companies. So for us, quality became this kind of absolute, kind of bar. So if I see it's a company I'll give an example. We were looking at a company recently where it's probably one of the cheapest stocks I've ever seen in my life. It's like something where I could objectively say this was a dollar trading for 20 cents. Absolutely. But then I started looking at the management, and I realized it has the management that, it's $3 management for, kind of for dollars, It's that the management that run the company paid themselves a huge amount of money. They made horrible allocation decisions in the past. And like the old me said, well, look, but this is a cheap company. The new me basically says, life is too short and move down. So that's how I deal with it, I guess, yeah.
Very helpful. Thank you so much.
My pleasure. By the way, I apologize. How's the microphone? Because I hear feedback. I just want to make sure you guys can hear me well. I can hear myself absolutely fine, so it's all about you. All right, we'll go there and we'll come back there. Okay.
Good morning. This is Rahul. I'm from San Jose, California. Thank you for hosting this event. I have a question as a retail investor, and I do really enjoy your letters. I read them thoroughly. The question is that, so if you guys are analyzing a new sector or a new industry or a particular business, beyond the statistical analysis, what you just mentioned, how do you look at new industries or areas or companies which are unknown to you, and how do you come up with better models beyond the statistical ones? Like the management side you said is one, but new traces, like say for example, the industry is cyclical, or the like tourism could be cyclical, construction could be probably cyclical. How do you analyze that?
All right. Well, for what I'm about to say, I'm gonna give credit to Brendan, my analyst, who's my ex-analyst, who's standing right there, and I'm gonna use this analogy. So because Brendan is a big sci-fi fan, and that he gave me this idea. But let's say you read a book by John Grisham, okay? Well, John Grisham describes the world that you know, right? Because he writes about America, okay? Now, let's say you read a book by Ian Banks, okay? Who's a sci-fi writer, right? And now suddenly there's 2 moons, 3 suns, people are not walking but crawling, whatever. Not even people, they're different, And suddenly you have to, for you to start, when you start reading this book, you have to build this new world, right? You have to understand how this society actually functions, right? Kind of investing is a little bit like this. When I'm analyzing industries that I've analyzed before, this is me reading John Grisham's book because I already know how that works. When I'm looking at the industry I know nothing about, it's a little bit like I have to build my own world. I have to understand where is the value in this system. Is it the suppliers who make most of the money? Who has more bargaining power? This kind of stuff. So when you look at analyzing a new industry, I have to build this completely new world for myself. And then you kind of start looking, once you learn about the industry, you start asking yourself a question, do you want to be in this industry? Okay. If you do, what kind of companies you want to own in this industry? Let me give you a couple examples. We used to own a company called Camping World, and our thesis was that when you buy our RV, the Camping World is the largest retailer of our RVs. Okay, and the RV industry was extremely fragmented. I forget the numbers now, but let's say there were 2,000 or 3,000 dealers across the country, and most of them sold maybe 5 RVs a year, some very small number. And then Camping World has 150 stores, and they sell, 500 RVs per store, some huge number, right? And what we found was this: when the industry was very fragmented, it requires you a lot of capital to sell those RVs. So when the industry went into downturns, which it always does, Camping World would pick up those dealers on pennies on the dollar. Okay, so using Nassim Taleb's framework, fragile, robust, and anti-fragile. Well, to me, Camping World was as an anti-fragile company. What it means, it's actually benefits in this industry from cyclicality. Okay, so in other words, if the industry was not cyclical, let's say I'm making this number up, let's say Camping World would grow earnings 10% a year. Because that industry is cyclical, long term that it can grow maybe its earnings 15% a year because it benefits from that cyclicality, because they have better balance sheet, better management, more diversified, this kind of things. So when you look at the industry, I start thinking about in this kind of terms. And then I look at, I'll give you another example. We still own McKesson, which is a drug distributor. And that whole industry only has three companies, like basically McKesson, AmerisourceBergen, which now has a new name, which I refuse to remember, and Cardinal Health basically control 95% of that industry, the three companies. McKesson, I would argue, is the best run company in that industry, but it doesn't really have a structural advantage against the competitors. So therefore, McKesson is robust, but not anti-fragile. So in other words, first of all, pharmaceutical distribution is not cyclical anyway. But if it was cyclical, it doesn't really have an advantage versus its competitors. So anyway, so this is the analysis kind of we go through, just try to learn, trying to understand how cyclical it is, how the industry structure. And so it's usually when you start a new industry, it depends on its complexity. It takes much longer than if I bought a company that I already owned before, like in the industry that I already owned before. So I hopefully answered your question.
Just a little follow-up.
Yeah, please, yes.
When you start analyzing or trying to figure out more about that industry, the new one, do you get your information from public internet, or do you have other sources where you derive all these information?
I think it's a good question. I think from everything. It depends. It depends. If I have friends who know this industry well, I'll talk to them. Sometimes I read books about the industry. Sometimes now I talk to ChatGPT a lot. And I really mean this. This is becoming such a great resource for us, just AI, because we have prompts. We have prompts that we just put in, and we get a research report of 40 pages. From deep research, so everything we have a position in Watches of Switzerland, which is a reseller of watches, luxury watches, I guess. And I actually ended up going to a lot of stores and talking to a lot of people. So, and my son Jonah, who loves watches, loved the hell out of it. So yeah, so anyway, so it's all of everything. So
thank you so much.
My pleasure. So.
Hey Vitaliy, my name is Anshu Bahadur. I'm also from San Jose, California. Enjoy the Saturday morning music that you send out. My question is a little broader, trying to stay on the economic side of things. As a value investor, is there a fundamental long-term economic and structural shift happening that we should be cautious of wary about?
Wow, that is such an easy question. Oh my God. Yeah, that's exactly. Yeah. Let me ask my chauffeur. Yeah, that's. I think the answer is yes. I think today you probably, a lot of assumptions you have made in the past about kind of the world economy, and have to be challenged. I mean, and our president challenges them for us. There's suddenly, I almost feel like today we are investing between the tweets. Tweets, I literally mean by between the tweets of our president. By the way, just quick question, microphone, just please tell me. Can you hear me closer? No? Dying. Can we try a different microphone? Yeah, sorry, all right, let's try. All right. Is this better? No? All right. How's this? We got an audio guy here. So is it better? All right. Okay, thank you. All right. So today we are investing between the tweets, literally, because I know I'm going to wake up one morning and find out that one of the companies we own could suddenly be highlighted by the president, or that industry could be impacted by the president. So one modification we have made in our portfolio, we reduced position sizes. Because I don't want to blow up on one of those tweets. And there are new risks that I'm not even, in the Donald Trump's terms, the unknown are unknown today. There's more of that. So we have today 60% of our portfolio is outside of the United States. Now, by the way, those of you who actually look at our 13F, which is our basically public filings of our holdings, I would caution you to be very careful with that, because you're really seeing only 40% of what we own, and position size and our conviction levels may not necessarily reflect what you see. Again, because I don't know, we manage $650 million, something like this, and you only see maybe $200 million, 250 showing up there. So just wanted to warn you about this. We've been looking a lot more internationally, and we own a lot of European stocks, but we own some Japanese companies as well. I would love to own some Israeli companies. So we've been diversifying ourselves from the United States as well. And it's a diversification that a lot of times I can buy high or higher quality companies and I pay less. So, but again, I have to work harder. Like, by the way, there is a cost to that as well. When I buy smaller positions, that means I have to work harder, because now I have, instead of 25 stocks, I have 30 or 33 stocks or something like this. So, but that's an adjustment we have made in our portfolio for that. But the world is changing, and I think this is one of the cases where you really have to pay attention to the macro. And if you don't, it's going to run you over at some point. It doesn't mean that I'm becoming a macro trader. That's not, I'm just looking at this as a source of opportunities, a source of risks, and kind of try to realign the portfolio accordingly.
Has gold entered your?
Gold?
Yeah.
It's kind of interesting. My colleague asked me yesterday, Robert asked me, what have you changed your mind over the last 5 years? And this would be an example where I have changed my mind. Like if I was on this podium 5 or 10 years ago, I would have told you that all the reasons you're going to hear tomorrow why not to own gold, right? Like you can't value it, you don't know the cash flows, etc. But I think the world has changed. The world has changed where we have 35 or 36 or maybe $37 trillion of debt by the time I'm done speaking today, and it's going up. And we are not really taking it seriously. We make all the sounds that we do, but really, if we want to deal with that debt issue, we have to deal with entitlements, and we're not touching this. So we also probably going to have, so long story short, we're probably going to have more inflation in the future. And with the US dollar is probably going to get weaker because of the way our foreign policy has changed. Because we're losing our soft power, because we're becoming a more transactional country. And therefore, to me, if you have a position in gold, not like 50% of your portfolio, but a position in gold, I don't think it's irrational. Not at all. We looking for a way to buy. I don't like, as an investor, I don't like to buy gold in a pure sense, like buy only like ounces of gold, because number of ounces is never going to change. So I'd like to find a way where I can have exposure to gold, where through business where number of ounces I own will grow as well, just even if I'm running the price. So that's how I'd like to do this. But it's not irrational to own gold today.
Thank you.
Oh, my pleasure. Yeah.
Hi, Vitaliy. I'm Chloe from Singapore. Once again, thanks for all the books and amazing newsletter that you have been publishing. And my question is, what's like what you say, if you invest in individual stocks, you do need to spend a lot of effort and energy. What's your take on index investing for people who don't want to spend so much time and energy on this? And what do you think is the expected return for index, let's say S&P 500? And one more question regarding like when you talk about diversification, right? Do you think that ETF will be a great way to diversify into other markets, be it like China, India, or like or other like developing sectors?
Thank you so much, Chloe.
Thank you.
First of all, let's disclose these biases that stare you in the face right here. Indices are not my friends, right? So like, you're asking for Barbara if you need a haircut. So you're getting the answer, all right. I'll give you several answers because it's a complex question. Okay, answer number one. If you are buying S&P 500 today, your return over the next 10, 15 years, most likely to be either negative or close to zero, very unlikely to be positive. If positive very mildly, most likely to be negative, just because the valuation is, where the margins are, where the profit margins are for corporate America are, and where the interest rates will likely to go. Okay, so if you just buy an average company, but what you basically buying, when you buy an index, you buy like a basket of stocks, right? So I'm not very excited about that basket in general. So now, could you do better in the index than if you give money to somebody who is going to be trading it? Maybe. So it depends. The question becomes, what are the alternatives you have? If you have somebody who you trust, who you, if I say Buffett was not 95 years old, but was 65 years old, then okay, would you rather give it money to somebody like Buffett or an index fund? That's a very simple answer, right? So if you have better alternatives where you're not going to blow up, I would argue, do that. When it comes to international investing, so the point I want to make is this. This is a very, very important point. When people look at index investing or ETFs, they find safety in diversification. But if you diversified yourself on a whole bunch of Titanics, are you really diversified? Like in other words, if you're buying a whole bunch of overvalued companies, yes, you remove the individual risk of one company blowing up. But if you're buying everything that's expensive, then you really not diversified yourself from the overvaluation risk. So that's something you want to be aware of. Now, let's talk about the international investing. Like some countries, for instance, we can't even buy if you wanted to. Like Americans cannot buy Indian stocks. Like Schwab, like for us to buy Indian stocks, structurally impossible. Nothing wrong with India, but Indian stock market is closed to American investors unless we register in India, which is for what we do is impossible. So if I wanted to own Indian stocks, I would buy an ETF, okay? Because that's not, Another thing is that when it comes to international investing, we have to be aware that when you especially go outside of Western world, and I'm speaking for myself, I'm a tourist and this is like very different cultures, and going to Japan made me realize how it's a different world. Like Asia in general, like for Westerners going to Asia, it's a different world. I would argue you probably have a competitive advantage against me. Just invest in Asia because you spend a lot more time there. So if you let's say let me come back to Warren Buffett. The late 90s when Korean stock market was blowing up, he kind of created his own index fund. Really, he just looked. He literally he knew nothing about those companies. He literally looked at the Moody's book of all Korean stocks and just say, okay, this company seems like a good business. I'll buy a little bit of this. And he bought, I don't know how many he bought, 50 or 10 or 15 or 20. He created his own index, basically knowing that he is the patsy at that poker table, but at this point in time, everything is cheap. So that's what index fund allows you to do as an investor like me. So I guess I can see that that strategy making sense. And if I hope I answered the question. I gave you a lot of answers. So.
Do you mind if I ask one more
Sure.
question? What's your take on Bitcoin? Since just now you talk about gold, right? Like what do you think about this?
Listen, I reserve a right 5 years from now say I changed my mind. So let me give you that's going to be my answer right now. Because but as of 5 years from now, I may say, you know what? Yeah, this is actually right now I see Bitcoin as it's kind of interesting. I usually don't use foul language in my letters, but there is Bitcoin and there is shitcoins, right? Okay, and this is an important distinction. So I have a much higher confidence on shitcoins, right? Right? No, I'm not talking about Bitcoin right now. Everything else, right? Because it's like I got this is a true story. A friend of mine texted me 2 weeks ago, and he says, "Take a look at this." And this is some kind of offering. I forget, a Brazilian company or Argentinian company or something. And he says, "Listen, they promised they're gonna pump this shitcoin, and it's gonna, I can buy it for a penny today, and they're gonna pump it, and then I can sell it for a higher price." And I said, just realizing, right now you're a fool, and now you have to find more greater fools for you to buy it. But this thing is worthless. It's literally, it's not worth a penny. It's worth zero, and you're just hoping that some other fools that it's complete. This is what Ponzi scheme looks like. Like this is what Ponzi scheme looks like. So and that was a kind of definition of a shitcoin, right? And there's, I don't know, if you can create something every 10 times a day like this, that falls into a shitcoin category. Now, Bitcoin is the reason. What has changed about Bitcoin over the last 6 months, and that's a structural change. Our government actually legitimized it, which is the dumbest thing I've seen a government official ever do. And by the way, this is not me being political. This is just common sense. When you have $37 trillion of debt, and your reserve currency, because you're a monopoly, do you want to cede something that can compete with you? That's idiotic. So So it's possible that 5 years from now, I'll give the same answer at Bitcoin as I give an answer about gold today. But I can add so little value to the conversation that I'm just I'm going to stick to what I know, I guess. That's
Thank you.
my pleasure. Thank you.